Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Welcome to the What Matters podcast, where we dive deep into the worlds of wealth management and financial innovation. I'm Mike Mershazadeh, and I'm with my co-host,
Ashley Ward. Hey, everyone.
And today we're thrilled to have Roger Gibson, the visionary founder of Gibson Capital, and Chris Sidoni, the managing partner and chief investment officer of Gibson Capital. Thank you today for joining us, gentlemen. I really appreciate that. We really appreciate that.
Great to be here. I'm looking forward to it.
So before we dive in, can you start by giving us a brief overview of your firm and along with your specific roles and responsibilities within the organization?
Chris, why don't you take that?
Yeah, so Gibson Capital is a registered investment advisory firm. We're located just outside of Pittsburgh, Pennsylvania. We work with about 170 clients throughout the country, more than 30 states. Today, we manage about in between $2 billion and $2.5 billion for those clients. We have 7 partners to the firm in terms of our ownership. We were founded by Roger in 1989. So why don't you take it from here, Roger?
Yes, I was looking over some of your kickoff questions. And in terms of the origin of the company, it actually, in its embryonic thought stage, started with an unexpected divorce I went through. I had a 3-year-old and a 6-year-old at the time, and we had a contested custody situation, and we were heading for court, and I had to do some drastic downsizing of my practice in a hurry because of where I thought we were heading. At the time, I was a partner in a regional financial advisory firm here in Pittsburgh, and my area of responsibility on behalf of that firm was managing the investment advisory part of the business. I had 65 clients at the time. A half dozen of those were investment advisory only clients billed on an assets under advisement fee schedule. The other roughly 60 clients were all financial planning clients. So as I thought about what I needed to do in order to free up a lot of time quickly, I decided at that point that I would simply get out largely of the financial planning part of the business and concentrate my efforts on the investment advisory only clients. They're the ones that had less time and energy intensity in terms of servicing, and it was a higher margin business. And so I made a deal with other advisors in my group to share revenues and responsibilities for the 60 financial planning clients for a period of 2 years, at the conclusion of which those clients would all be serviced entirely by the other advisors, and I would be off on kind of an investment advisory only kind of practice. 2 things happened concurrent with that decision. Suddenly, I freed up gobs of time. And at the time, I had been lecturing on the topic of asset allocation. So I had developed, based on basically the work of Harry Markowitz in modern portfolio theory, and a decision-making model where you engage clients in the investment decision-making process in the design of their portfolios. All those portfolios in terms of approach were multiple asset class diversified and strategic in nature, no market timing. So the lecturing that I had done was really introducing to the financial planning world a consultative model where you educate clients, make them better investors, and through that process, you'll improve investment results because you're going to be increasing the likelihood that clients don't abandon strategy. So this took off. I had a very busy lecturing thing going on the side, regional, national, and occasionally international conferences. And the topic was always portfolio design, asset allocation, managing client expectations. It was kind of working at the intersections of behavioral finance, which did not exist as a science at the time, and asset allocation. Oftentimes people would say, why don't you write a book on this? You've really got this kind of thought through. And I thought, well, yeah, someday. Well, suddenly I had all this time. So I decided, well, this is my shot. No one's written a book on asset allocation. I'll give it a whirl. I was terrified, but I got through it. I had a good publisher, and the book got really good support from big people in the field whenever it came out. And the launching of my firm coincided with the release of the first edition of that book in 1989. So I've had a career that has basically had one foot a little bit in the academic research, lecturing, writing world, and the other foot in the world of actually, working with clients. And it's the actual client engagement work that informed the writing and the lecturing. It wasn't just ivory tower stuff. And it was the lecturing and the writing and the researching that, of course, informed the work we do with our clients. So that's how the whole thing got started.
Yeah, I see that the book's been published in multiple languages as well. So
yes, I mean it's still being sold. So it's in year 34 right now.
Do you know how many copies you've sold in total?
No, I don't. But McGraw-Hill's been my publisher, and they told me that when a book reaches a third edition, it's considered a classic in the field. And we're in the fifth edition, which I now term the final edition because we're not going to try it again. It's too much work. And Chris co-authored the fifth edition with me, by the way. So he brought some new material to the topic. So I'm just absolutely amazed that after 30 some years, people are still buying that book. So I was really fortunate there that I caught a topic that hadn't been written on and kind of caught that wave and wrote it out for most of my professional career. I got lucky there.
No, that's really cool.
Very cool. That's quite the achievement. I know writing a book isn't easy, or so I've heard. I haven't wrote one myself, but congratulations.
Thank you.
Ashley, I'll let you get into the next question because I believe my question was answered through.
Yeah. So thank you for telling us a little bit about that journey there, Roger. Chris, can you tell us a little bit about your background and what inspired you to enter the wealth management industry?
Sure. Yeah. So I actually started in the profession as a sophomore in college. I went to a job fair and I landed an internship role at a small regional RIA firm, independent organization. And I knew I wanted to be in the realm of finance, but I didn't know specifically how I wanted to apply that at the time. I think I was just really lucky that I found this profession because for me, it was a good combination of people skills and financial modeling skills. And so kind of the quantitative and the people side of the profession appeals to me and always has. And so I actually worked in the profession my sophomore, junior, and senior year of college. So I felt really pretty ready to step into the profession at a young age. So I stayed with that organization for a year. I went to a large regional bank and worked in their private wealth management division. And I was really young. I'm in my mid-20s. I'm working with clients. I'm kind of off and running, learning about the incentives of that organization and how to work with clients. And I really felt like I wasn't looking for a job at the time, but I didn't feel like I had anybody around me who was going to help me grow professionally. And it was around that time that someone introduced me to Roger and his firm. Again, wasn't looking for a job, came and interviewed. I just heard everything that I wanted to hear, even some things I didn't know that I needed at the time. Not just about how I could grow professionally, but how this should be done for clients, how this work should be done for clients, for the benefit of the client and not the organization. And so I knew right away that was a fit. That was 2007. So I've been a part of the firm ever since.
Wow. So 2007, before I get into the next question, 2008, 9, and 10 were pretty brutal, right? So becoming a part of the firm in those years, it couldn't have gotten worse, during that time in those next couple of years. How did that shape you into thinking when you got in, were you like, man, did I make the wrong decision? Or were you like, did you see opportunity there?
I never thought that. I mean, in my 20s, when you join the profession when you're really young, at least for me, I had a bit of a chip on my shoulder to prove that I was credible. And the way that I went about that was credentialing. So I launched into the CFP program first, and became a CFP certificate, and then I went to graduate school at local school Carnegie Mellon. So I finished my MBA there, and then I went into the CFA program. So I was doing those things in my 20s, and then I was also getting on the ground experience with clients through really challenging markets. But I never felt like I was in the wrong place. I did at times feel like that maybe I didn't belong to be in front of the kinds of clients that I was in front of. I think Roger always really trusted me to work with certain large, sophisticated, challenging clients. That was always a really positive thing for my career. At times, I felt like maybe that part was going too fast for me, but otherwise, I never felt like I was in the wrong place.
Thank you. I appreciate that.
I only find out now that he was having some crisis of confidence. So I guess it didn't show, Chris.
Sounds like you had a good mentor.
Roger, were there any pivotal moments or challenges you faced during that time? Within your organization?
What, you were going back to 2008?
Yeah.
No, is that what you're asking?
Exactly, yes.
Oh, it was interesting because during that global financial crisis, I have to say, I was still speaking publicly, doing, national, regional kinds of conferences. And of course, that was an awful, awful global financial crisis. And I found it not just kind of shouldering the responsibilities you have with clients to keep them, to the strategy and as comfortable as you can in a market that's anything but comfortable. And and then turning to your professional peers who are putting your feet to the fire. And I do remember coming out of that global financial crisis thinking, I really got to get on a glide path to move ownership of this firm on to the next generation. I thought, I do not want to be the only owner of this firm during the next global financial crisis. It's time to move the weight of that into the backpack of the next generation. And so that set us off on basically a 10 to 12 year program of gradually turning over ownership to the next generation, which has now been completed. And that really feels good. But the global financial crisis was part of what pushed me there. It's hard, it's if you care about your clients and you care about their well-being, you can't just be philosophical when you're going through market conditions like that. It's a weight you carry in your backpack, and it's a lot to carry.
Gotcha.
Absolutely.
Thank you.
Yeah. And going off of that, were there any key lessons you learned through your entrepreneurial journey, Roger, that, you wish you knew when you started?
Well, I got started and at a time where I didn't have a lot to lose. And I think that was, again, it was kind of going back to my personal circumstances at the time. And as I look back on that, that was really helpful because when you got nothing to lose, you could be a little bolder. I can remember taking a walk with my dad. This is very shortly after I founded the firm. And he says, well, what are your goals? What do you want? What do you want? Like in terms of what kind of business you want to try and build. I said, my goal is to have 50 clients with $100 million under advisement. And that was bold. For a young guy at the time, because what was it, 1989, I was 38. And I already had the first edition of the book out. That was still a bold goal to have. And in pursuing that goal, I made a decision early on that I would be looking at $2 million up relationships and that I would turn down smaller relationships. And I remember a comment made by Charles Ellis, who was the founder of Greenwich Associates and their managing partner for 30 years. Greenwich Associates was a business consulting firm that worked with literally every leading financial institution in the world. Charlie Ellis is just this brilliant guy. And I read a transcript of an article of a presentation he had made at a CFA conference. And the article was called Characteristics of Successful Investment Firms. And this was just a gold mine of great ideas and observations about the profession. But one of the things he said in that article was, your market is determined not by what you're going after, but by what you turn away. I thought, oh, that's hard. That's hard, right? Because whenever you need business and you're not making a lot of money, profitable business that's not the business you really want is a seduction to be avoided. So I turned away under $2 million clients at a time when that would have been very profitable business to take on. But because I kept turning it away, my business gravitated toward and eventually far exceeded the target market that I was going for. Had I simply accepted the profitable business at the time that wasn't the best business to hold for the future, my business would have gravitated around smaller clients. And we are a firm that take our clients seriously. A question that I keep posing to my group that I always pose to myself, who's more important, our clients or our prospects? I think many firms, prospects are more important than clients. And if you have that professional attitude coupled with a policy of taking on profitable clients that aren't the best use of your time, what happens over time is that as your profits grow, your margins decline. And with a declining margin, you're more susceptible to business setbacks, right? So you go through a global financial crisis and you got a thin margin. You're in trouble. And as you take on more and more clients, your ability to really pay attention to your clients diminishes. So we are serious about making sure our clients are more important than our prospects and that we have a generous coverage of advisors relative to clients. So we've got 170 clients. We've got 5 advisors. So that's like 35 clients per advisor. If you want to do good in-depth work for your clients in the space we're in, with the asset basis of our clients, you can't do that if you're taking care of 100 clients. You just can't do it. You're spread too thin. So, this notion of, with great discipline, turning away business that would have been profitable, kept our margins up and kept us always poised to have a good relationship between a relatively small group of clients we were serving relative to the advisory talent that we were bringing to them to take care of them.
I love that. Yeah. Quality over quantity, right? And
but that's hard to do.
Yeah, right? When it's right there in front of you. Chris, what about you? Any valuable lessons that you learned along the way of your career? Potentially maybe some valuable lessons that you learned from Roger?
I'll just share one for maybe younger listeners. When joining an organization, to look for opportunities where you can grab some responsibility and do something that needs to be done. I mean, there's always something that can be done better. You can even ask your older colleagues, and what might that be? And for me, I was lucky at the time. Our advisors were really focused on client work, and we had a little bit of an opportunity for someone to come in and spend more time on investment research. And I came in early and kind of filled that void, and it set me on a certain trajectory within the firm that was beneficial for my career. But it was really just because I was able to identify something that needed to be done and could be done a little bit better at that time. I think any younger folks that are listening, there's always that kind of opportunity in an organization if you're willing to look for it. And once you prove that you can do that, then you can build on it by finding the next bit of responsibility that you can grab. And I think your older colleagues will never really, that's something they'll always welcome, someone coming in and helping out and pitching in that way and taking responsibility.
And that, I guess, dovetailed with my goals. Again, post global financial crisis, I was looking for somebody to turn the mantle of chief investment officer over to. Along that path, we made Chris eventually the director of investment research, which was, just a step away. And then got to the point where it was clear he knows how to set the agenda. He's got a first-class investment mind. He knows how to work with everybody. The advisors respect him. He respects them. It was an easy thing to just say, okay, you're chief investment officer. And I said, I don't know if your backpack feels heavier, but mine feels lighter.
Right. And Chris, do you have any advice for our listeners to maybe for those aspiring wealth managers to help them stay resilient in the face of industry disruptions or uncertainties?
The thing I always go back and think about is just, I replay client conversations, and, sometimes if I get down on, something that I see within the profession or how I think things may play out in the future or markets or what have you, our clients need us to be there for them. And we've developed a certain kind of trust that's really hard to develop, right? It takes time to do that. And so I think the resiliency that I draw from is knowing that 5 and 10 years down the line, no matter what's going on with financial markets, their financial situations are going to be complex, and they're going to need someone to help them with that complexity. And we're going to be in a good position to be able to do that. So that usually helps me out when I'm down.
Thank you. And what are some of the conventional strategies or approaches that you believe contributed to the success of your firm, Chris?
Roger touched a bit on it. I think the collaborative nature of our investment strategy is what's most unique, but also what's helped us the most through time. So I think it's unusual. Maybe a more common model would be the advisor learns something about the client's risk tolerance and financial situation, lines them up with a model portfolio or something that meets their needs in terms of their risk tolerance and time horizon. And I think that can work. Our approach is more to design a strategy with a client. And what happens when you do that is they can develop I think a more significant level of conviction in their approach, right? Because they understand the strategy at a deeper level. And that conviction usually is the difference between being able to stick with a strategy when it's not performing well. And that's not just a financial crisis that can cause that. That can also be a situation in which the strategy just underperforms how they want it to perform, right? It could be a situation like the last couple of years, which have generally been a good time to be in markets, or like the late 90s. So there are lots of different strategies, or lots of different scenarios that can knock a client off course. And when they've been involved in the design of the portfolio, we think they have greater conviction to get through, one of those scenarios.
Thank you. Well, to highlight on that, coming into last year, being a down year, right? And then going into this year, how did you guys operate with that? Did you guys have your clients bombarding you, saying, gosh, I wish I would have pulled my money out of the market, or they really followed your lead for everything?
They certainly were not bombarding us last year. I guess, Mike, if I could, I want to go back and contrast like 2008 and maybe 2020. This might be a different way to answer your question. But in 2008 and 2009, those were really challenging client conversations. I mean, a couple that I'll share with you anecdotally that stick out to me. One was a client that called in. He had looked at his report, looked at the statement, and he knew he was down between 30 and 40%. And in dollar terms, I mean, he could translate that to, how much he had lost. And as we had this conversation just to confirm what he had experienced, I mean, I was almost sick to my stomach, just feeling what he was feeling and going through that moment. And for me to carry that with me the rest of my career, so that, this is not just a philosophical conversation. This, when we're setting risk parameters for a portfolio, this is what can actually happen in real life. Or another client at the same time said to me, Chris, I really think markets are going to rebound. I can't take risk beyond the threshold of loss that we've already experienced. Like I've got to de-risk the portfolio. Even though I think the markets will recover from here, I'll take those with me forever. But I would contrast that with 2020. That happened so fast. It's almost like clients didn't have a chance to react to it. We didn't have anybody calling in, and I would say that was similar last year we didn't have a lot of really challenging client conversations around strategy redesign, financial plan redesign, cash flow modeling. It just wasn't big enough and wasn't prolonged enough, really.
Wow. Yeah, because I could tell you guys something about me. Our podcast, I believe, started at noon today. At 11:30, I had a call with my financial advisor. They're over there they're with Westwood in Texas, and I said I want to de-risk, and I cashed out 25% of my portfolio. How would you guys? How would either one of you? How would you have handled me if I called and said that I wanted to do that?
Go ahead, Roger. You take this call.
Yeah. Would you say that? Well, let me finish here. Would you say that right now would have been a good time, or would you say, "Hey, listen, we never advised to take money out of the portfolio"? And the only reason why I did that is I said, "Hey, listen, I feel like I'm too leveraged in the stock market, and I want to put some money into treasuries."
Yeah, my response would be that it's a time to rethink your asset allocation. In other words, if you hit a market environment where you can't stick to your strategy, I would say I would be of no help to you in terms of predicting what's going to happen next. Which asset class is going to go up or down, or what the relative performances are going to be, and so on. That's all unknowable. That's always unknowable. But we do need to make sure that the overall structure of your portfolio has risk characteristics that are consistent with your ability to tolerate the risks associated with it. So when you pick up the phone, you say, I want to take 25% out of the equity side of the portfolio and move it to the fixed income side. I would, first of all, discourage you to do that if you're doing it opportunistically. In other words, if what motivating you is a short-term view of what the market might do next, I would try to recommend that you not go down that path, because that's basically a market timing. And the likelihood of you successfully being able to foresee a market event with any kind of real confidence, now you might call it and you might be right, but were you right because you saw what was coming, or were you right because you got lucky, So
right.
I think markets are generally unknowable in the short run. So the more important question you raise by your impulse to change your allocation is that's a sign to me that the structure of the portfolio wasn't well matched to your risk tolerance. So I would go back and I would re-examine that from that perspective. Now, we go through a decision-making process, come down to a fresh new asset allocation strategy. Maybe that new asset allocation strategy indeed has 25% less equity. All right? But then I would say that's a good confirmation that what you did is a good decision for you. But my follow-on question would be, let's say the clouds part, things look great, markets start moving up again. Are you going to be calling me saying you want to increase your equity? Because I'm going to try and talk you out of that one too. In other words, I think the right asset allocation for you is an all-weather strategy. And the test is what's happening during market extremes. Are you still following the strategy? And we want to keep on working on that until we find that sweet spot where it's a structure that's going to get you to where you want to go long term. And along the way, you're going to be able to kind of keep the discipline of that structure.
All right. Thank you for that answer. I appreciate that. And my last question in this sector is, and I believe this could go with Chris, how do you measure the success of a financial advisor?
To me, it's qualitative, and it comes down to the strength of the relationship that they can build with the client. I mean, they have to be able to develop that trust, and occasionally provide answers that the client doesn't want to hear. That's part of being a good advisor. But I would not know how to go about that in some sort of quantitative scoring way. It's almost too hard to know that without understanding what's happening on the inside of a relationship. And some markers that you can get from an outsider point of view is, does a client are they so thrilled with their service and the relationship that they'll refer a friend or a family member. Not that that's something that we ask for, but you can see that in an email. So a client will email and they'll say, boy, I've been singing your praises and I'd really like you to meet so and so. Well, that's a pretty good indication. But to me, it's all about the qualitative factors around what kind of trust level you built with the client and how well you serve them.
Thank you.
That's a great answer. So we'll kind of go into leadership. You guys are both leaders in your firm in the industry. I'll start with you, Roger. What are some of the guiding principles or leadership philosophies that you think have played a crucial role in shaping your firm's culture and the direction of your firm?
Maybe this is a good time to go back to that article I told you about by Charlie Ellis. So he made 8 points in his article. And these are his, synopsis of characteristics of successful firms. Always remember the clients come ahead of the firm. Always remember that the firm comes ahead of the individual. And always remember, as an individual, that professional commitments come ahead of financial rewards. Take a long-term view. Have a clear purpose. Get top people. Have high professional standards and maintain discipline. That's really good, isn't it?
That's great.
I like that a lot.
Yeah, I mean, I have returned to this article again and again. Every couple of years I go back and I read it again. And I think that if you do those things, man, you're on your way.
That's fantastic. Yeah. And Chris, have you faced any challenges as a leader that possibly have led to significant innovation or change within the organization?
I got to say, Ashley, I'm still kind of on my journey in terms of becoming a better leader and a better manager. I have come up through the ranks of being an advisor and a research person, and now I'm in a more senior role, and I'm trying to get better at being a leader. Maybe one thing I could say is just this has helped. The following has helped me. I think my colleagues know that I have a really sincere interest in the development of their careers. And I think that has helped me become a better leader and has built some trust between me and staff. The rest of it I'm working on, to be honest with you.
Right.
I have one other thing I'd like to add on that theme, and
Absolutely.
that is that I was really lucky to be able to work in this business side by side with my wife for many years.
Oh, wow.
When we got married, my wife was running a large nonprofit here in Pittsburgh. And she was co-executive director. They had a $4 million budget. They had dozens and dozens of people offering all kinds of programs, psychiatric outreach to homeless people, shelters for homeless people, soup kitchens, more than one, sports programs for the poor, loan programs for the poor. And everything was built on an empowerment model. So if you take somebody off the street and get them, see if you can get them straightened out and a place to live, then put them on the payroll. And they'll work on behalf of the nonprofit to go out and help more people like themselves, right? And so she ran this just with incredible success, but it was to a point where she needed to kind of move on. And so I said, hey, I got to move this firm so it's not overly identified with me and it's more of a firm and less of a kind of a practice that revolves around me. And so could you come in and consult with us? So she came in and consulted with us. That went well. And then just, slowly, I kind of just roped her in and she eventually was, chief executive officer of the firm. She ran this place. To the extent to which we had business success, that was largely her doing. On my very best days, I was an average business person. I'm not a good manager of people.
I feel you there. I feel you there.
And I am not a good manager of processes. That's not who I am. And I don't like it either. I don't like it and I'm not good at it. But she was amazing. Oh my God. She had the best right brain, left brain coordination of any human being I've ever met. Highly intuitive, very creative, and terrific with numbers terrific analytically. She was a real master, and the extent to which we've been able to carry on what she put in place here in this firm, the business success really is all about what Brenda was able to do here while she was running the show. And now that it's moved on to the next generation, I think she'd be proud. I had to say it in the past tense because my wife passed away. She would be proud with how this group's doing. I think the firm's doing just fine. The next generation, sure, there's issues and there's problems. There's people. There's going to be, right? But in general, I think they are doing a good job working together and keeping their head screwed on straight. And again, trying to put the firm ahead of themselves and trying to keep the clients ahead of the firm. They're doing a good job continuing to live that out. But it's I really believe it's my wife Brenda's legacy. She was the one that put all that in place and made it what it is.
That's
Thank you
beautiful.
so much for sharing.
Yeah, and that kind of answers the next question I was going to ask you about, how do you foster a dynamic team culture? But it sounds like Brenda really did it with putting the people in front of the firm. That's great.
Yeah, I mean,
thank you for sharing that story.
Yeah, she was something.
So as far as the future of wealth management, because these are the questions I deem to be fun. And I think it's a question for both of you. And Roger, I'd like to get your input on that first, and Chris afterwards. What does the future of wealth management look like to you guys?
Boy, for me, I think our professional values and what we stand for and how we've structured the firm in terms of, a very beneficial client advisor ratio, maintaining a good margin so that we are financially a viable ongoing concern through various markets. I really, and the investment approach we take, which is strategic, I think and consultative, I think all of that will move into the future from the past and adapts into what will be a changing world. One of the things that I think is on the horizon is going to be more and more what we're dealing with is this whole climate change issue. I think broadly, and I would say this in terms of the investment advisory profession, and I would say it broadly across just people. I think there's a great underappreciation for just how truly catastrophic our future may become. And every time they update these climate studies, the updated conclusion is it's happening faster than we thought, and it's going to be worse. Occasionally, there's some bright spots here and there in terms of actions people taking and commitments and so on, but this whole thing is moving fast and it's moving in the wrong direction. And I think the pandemic, in a way, gave us a preview of coming attractions. What's going to happen? I mean, when there's some extra pressure on the system, how are we going to respond? Are we going to come together as a people? And are we going to do what we need to do to take care of each other and get through it? I don't know that we came through with blue ribbons on that one through the pandemic. And I think it was just a small preview of coming attractions for what might get set in motion and what's going to get set in motion with climate change as it worsens. So I think that's going to be the big investment issue for the future. And I also think that as the world gets rockier, the client advisor relationship becomes more important. You won't just be able to build a business with as many, clients as you could possibly, take on and give them model portfolios and every once in a while talk to them. I think you're going to need, and the value of the client advisor relationships is going to be more and more important in that world. Chris?
Well, I think one theme that we're seeing already is just consolidation. So I think independent wealth management organizations are getting larger, not all of them, but some of them. And I find this a little ironic in the sense that the RIA profession came about, I believe, when certain founders left large organizations, by and large, right? So banks or brokerage companies, and said, this is not the model I want to operate in. I want to be completely independent. I want to do things for the benefit of the clients. I'm going to go do it on my own. And I think what will happen is that the RIA community will result in several larger organizations that ironically look more like the banks and brokerage firms that the founders left originally, right? So I worked in a bank at one point. And so the incentive structure there is more and more clients per advisor. You generally have kind of a recommended list of funds that you can bring to a client. It's built around efficiency. It's more of a business first mindset. And I could see the profession moving that way, not for malicious reasons, just because we are businesses, right? So there's kind of a general push in that direction at times if you're not careful about it. So I think that's one potential vision for the future. That's not altogether good. One other thing that I think will happen is if you look at the way like larger law firms or accounting firms are organized, you've got the partner, associate, paralegal structure, and you have the development of niches for the partners that they're pursuing a certain niche in law or accounting or what have you. And I could see that happening as well within wealth management. Again, within the context of these larger firms, that wouldn't be such a bad thing. It could be, good for clients to work with someone who's specialized looking at certain kinds of client scenarios. But those are two observations about a possible future.
Thank you. I appreciate that. That leads me to my next question. What is your vision for the future, of your firm? Do you guys have plans for expansion? You mentioned something about consolidation, so that's what made me want to bring up this question. Or new initiatives to continue building on the success of your present RIA? Any plans of acquisitions or organic growth? How do you guys see the future there?
We do not have plans for growing in that way. And so the vision for our firm is sort of the opposite of the vision that I just articulated. We're going to be small. We're going to work with relatively, fewer numbers of clients. We're going to try to do really good work for those clients. We're not going to be overly concerned about how many new clients we get this year or next year or the year after that. If we do our jobs well, certain people, clients will find us in the future, new clients. And so it's taken me some time to get there, I think philosophically. If you would have asked me that question maybe 5 or 10 years ago, I was a little bit more concerned with more consistent growth for the development of career paths for younger advisors and younger staff members. Today, I would say in relation to 5 or 10 years ago, I care less about the ways in which we're going to grow or how much we'll grow. I care more about the quality of work that we're doing for our clients.
I appreciate that.
This reminds me of another one of Charlie Ellis's comments. He said, professional values do not conflict. He said, good professional values do not conflict with good business values. They should support each other. But he says, if you feel any tension between the two, give the nod to professional values over business values. Simple, right? So I like that. Now, it's not always easy to do. But if you keep doing that over and over and over again, every time there's a fork in the road, then you'll find that the business takes care of itself.
Absolutely.
Thank you. And Ashley, I'll let you delve into the artificial intelligence impact there.
Yeah, so we're seeing this expectation of increasingly digital and interconnected world. We're seeing lots of talks about AI lately. Chris, in any ways, do you see AI, transforming the wealth management landscape? Do you see it, in terms of client engagement, it increasing that way, or operational efficiency? What do you see AI's role potentially in the space?
I just think I don't really have much that's intelligent to add on this topic. I mean, I can certainly see how it can increase operational efficiencies and we'll be able to access information in a better, more efficient way. But I'll just stop there because I really don't think I have much to add to the topic.
Fair enough.
Are you threatened at all by it from a business point of view, Chris?
No, I don't feel threatened by it. And it's interesting. Roger and I had a bit of this conversation before we started, and I said, I don't feel threatened now, but clients who are 70 versus 60 versus 50 versus 40 in age, they want different things. And so I don't want to assume that our clients of the future want to interact with us in the way that our clients do now. I mean, they may want to interact differently. And so we just have to be agile enough to be able to integrate technology as it comes about. So, again, I don't feel threatened now. I want to make sure that we're continuing to kick the tires on things that come along and making sure we're integrating what we need to.
Absolutely. Yeah. Do you see any potential ethical considerations that wealth managers should keep in mind as they embrace AI technologies?
I don't have a good answer for you.
No problem at all. I appreciate it. Yeah. It's a tough one to tackle just because, there's still so much unknown and it's still so very new, but it's quite interesting. It's the AI talk. It's something that's just up and coming and new things happening every day with it. But we'll move on to, something that's maybe a little more exciting. Mike, take it away.
So I wanted to talk to you guys about exciting investments. Are there specific investment sectors or opportunities that you find particularly promising or intriguing at the moment? Anything that catches your guys' interest for your firm?
My somewhat joking answer for you is bonds. I think bonds are super exciting. And of course, I'm kidding because bonds are not the most exciting part of a client portfolio, but now they're actually competitive in terms of an expected return, relative to what we might expect from equities. And maybe more broadly, I would say because we're not tactical, right? So we're not trying to identify an asset class that we think is going to outperform. What I would say is that I would be surprised if U.S. stocks are the leading asset class in terms of returns over the next 5 or 10 years, like they've been over the last 10 to 15 years, right? So
really,
I would be surprised by that. Other asset classes, I think, are competitive in terms of expected return, and it's typically unusual to have the winner from the last decade, be the repeat asset class winner, in the decade ahead. So I think diversification across multiple asset classes will again be important over the next decade plus, but we'll have to see how it plays out.
Oh, I like that answer because as of 30 minutes ago, I just joined the bond club. So, and what advice do you guys have for investors who are interested in exploring these exciting sectors of bonds, I should say? Do you see any potential? Should they be cautious about any potential risks with bonds? I know, the only thing that could, hurt that would be interest rates probably going down. Do you guys see that happening? What's your view of the future there?
Well, I guess my bond answer was a little tongue in cheek. So let me broaden it to for clients who are going to, for investors who are going to embrace a multiple asset class approach, who had previously been more U.S. centric in their approach. The consideration that they want to think about is how they'll respond in an environment in which U.S. stocks remain the leading asset class in terms of return, right? So if someone diversifies more broadly today and over the next 3 to 5 years, it's the same large technology companies that go on to outperform, and it's U.S. stocks that perform really well against non-U.S. stocks. There's a certain psychological pressure that builds up when you've embraced that kind of diversification away from your home market. And you don't want to overlook that. In my experience, clients tend to underappreciate their sensitivity to that issue. So if someone's about to embrace a broader, a more broadly, diversified approach, that's the trade-off that they really want to think hard about.
Thank you.
And to end it off, let's talk a little bit about the economy. Roger, you kind of hit earlier on your thoughts about, long-term versus near-term. Chris, tell us a little bit what you think is in store for the economy.
We don't have anything super helpful to add on this topic either. We're not economists. Our investment approach isn't going to be predicated on what we think will happen with interest rates or employment or any of those things. We just don't know how to handicap that, nor how to turn it into an investment strategy. So I'm sorry, I'm gonna pass on that particular question.
Absolutely fine. I appreciate that. This will go to either one of you. Any advice you can, give to individuals to help them make informed financial decisions during this current economic state?
I'll take that one first, Roger, and then maybe if you develop an answer, you can chime in. So I would answer also in a way that dovetails with something that I'd like to see within the profession, greater evolution toward a focus on the investor rather than a focus on markets. I think there's so much focus on markets and investment vehicles and trying to figure out what's going to happen next. And if you turn on CNBC or you open up Barron's or basically all the stimuli for an individual investor, it's all market oriented. It's super hard to have an edge there. I mean, most investors and most advisors just aren't going to have an edge in markets. But where they can have an edge is in better understanding themselves, their clients, investors. How do they think? What is their tax situation? What are their real risk preferences? What's really underneath all of that in terms of their psychology? And really embedding that deeply in the design of the portfolio is what I think the profession is missing. Like asset class preferences, how we implement within asset classes, all of those things can be more deeply influenced by the investor, right? Like how that investor is made up, their psychology, their tax situation. I'd like to see more of that. So I'll stop there.
I completely agree with what Chris just said. If our job is to exploit inefficiencies, the biggest inefficiencies are inside the client, not inside the markets. So that's where the real work is that has the best payoff. And interestingly enough, it gets back to this issue of if you're going to take that deep dive with a client, then you should have a limited number of clients. Otherwise, you can't take that deep dive. So it does kind of dovetail back to what kind of practice you have. And if you're putting clients first, that means having adequate manpower to take just that kind of dive with the client to make sure those inefficiencies inside the client's decision-making process are fully exploited to their benefit.
Fantastic. Well, Chris, Roger, thank you both so much for sharing your wisdom and your expertise with us and our listeners today. Your journeys and insights provided a treasure trove of knowledge for our listeners, so we really appreciate it. And I think I'm going to start using that little line that you gave us, ask what you can do better. I really like that. So thank you so much. And to our listeners, thanks for tuning in to another enlightening episode of the What Matters podcast. Stay tuned for more exciting conversations on wealth management and financial innovation. Thanks, everyone.